Dear students, I'm your course instructor, Dr. Mazullah Khan. I welcome you to my video lectures. Today we will start chapter number 18, which is financial statement analysis. In my last lecture, we finished chapter number 17, in which we learned preparation of statement of cash flows. We use indirect approach, which is the most commonly used approach in the industry. And the reason that one is most popular because it's simple to implement. So as the name suggests, in financial statement analysis, what we will do, we will use actually financial statements and we will use that data for some analysis. And we use those analysis actually for decision-making process. Decision-making is something extremely important in any management program. As a finance manager, you will be required to make those decisions almost on daily basis. In this chapter, I will motivate the topic that why do we need financial statement analysis in the first place. And then we will go to the hardcore areas, which is horizontal analysis, vertical analysis, and then we will use financial ratios as well. So I made some videos for my other class in which I'm teaching business finance. Course code is MS281. I made some videos. So what I'm trying to do, actually, I'm sending you those videos. I used, although a different book, but at the same time, I use almost the same concepts because at the end of the day, financial statement analysis, all books are using these horizontal analysis, vertical analysis, and financial ratios. I used fundamentals of financial management in those videos. So I made some references, for example, to chapter number 3 and other chapters. So please ignore that. Only focus on the content that I covered in those videos. If there is any confusion, you have my email. My email is mazullah@gkey.edu.pk, or you can drop me questions at my WhatsApp group. So I wish you all the best for my videos. As I told you at the beginning of my lecture that management is a science of decision making. And as I told you in chapter number 3, finance managers make 3 key important decisions: investment decisions, financing decisions, and then asset management decisions. If I ask you a very simple question, and I'm sure most of you will answer this correctly, are these decisions taken random or are these calculated decisions? Of course, they are not random. They are actually calculated decisions. If managers take random decisions, of course, then you do not need training. You just sit on your chair, toss a coin. If it's a head, you make one decision. If it's a tail, you make another decision. Of course, it's not that simple. It's a science, and you have to take calculated decisions. This definition is actually coming straight from the book. I copied it from the book. So financial statement analysis is the art of transforming data from financial statements into information that is useful for informed decision making. So whenever you're dealing with any definitions, please pick the keywords first and then try to find a relationship between those words. So the key terms in this definition used are transformation, data, information, and decision. So data, if you look at the data are just abstract numbers. It doesn't mean anything. You have to transform it. You have to, in other words, analyze it. And then after the analysis, that data actually is made into useful information. And then those information we can use for decision making. So if we look at the decision-making process, we start with the data and then we analyze it. As I said, data is just a set of abstract numbers. It does not mean anything.
you have to analyze it. Once you analyze it, of course, it's converted into useful information. Now, it has to be useful. The analysis should lead to useful information. And of course, those information we can use for decision making. Now, the most important question is, where is this data coming from? In a decision-making process, we start with data. So where is this data coming from? In financial statement analysis, actually, this data is mainly coming from financial statements. And whenever I say financial statements, it mainly means balance sheet and income statement, actually. So this is my mistake. Income statement. Apologize for that. Income statement. A typical balance sheet would look like this. So this one is the asset side of the balance sheet. Of course, you have cash, accounts receivable, inventories, and these are your current assets. Current assets are those assets which can be converted into cash in less than 1 year. Total assets is $2,169. And if you see, on the other hand, actually, the total liabilities and owner's equity, it's also $2,169. And of course, it makes sense because total assets is equal to total liabilities plus owner's equity. The most important message that you should take away from this slide is this one. As you may remember from your financial accounting course, balance sheet is made as on date. So this is the financial position of Basket Wonders as on December 31st, 2003. Income statement, on the other hand, if you see, it's for the year ending. So all these, for example, net sales, this is the total dollar amount of sales for the whole year, starting from January 1st, ending at December 31st, 2003. So the main difference between balance sheet and income statement, balance sheet are made as on that, on a specific time. An income statement is actually for a whole year or for a whole quarter or for a whole half year. So it's made over time. So there are two different types of data, and I'm not talking about the types of data in econometric sense. I'm talking about data in accounting sense. So stock data is actually measured on a specific time as on date. So by this definition, actually balance sheet data is stock data. And then the other type of data is flow data, which is measured for an interval of time, over time. So income statement has flow data. So please keep this distinction in mind. So whenever we are talking about balance sheet data, it's stock data, because all the numbers, for example, cash, it means that this is the dollar amount or rupee amount currently now with the company as a cash in bank account or cash. Similarly, let's say if I'm talking about expenditures, which is an income statement amount. So it tells us the total dollar amount or rupee amount of expenses over a period of time. So this distinction is extremely important. So whenever you're dealing with data, you have to have that differentiation in mind, whether it's a stock data or it's a flow data. Financial analysis. So as a finance manager, one of your job is actually to evaluate the financial condition and performance of firms. This can be a firm that you are working in, and this can be a firm that, let's say, if you are interested to invest your money in. Condition and for performance, although they look similar terms, but they are actually different. And I'll give you an example. For example, Air Canada, it's a big airline, it's a giant. The condition of that company is solid, it's a strong company. But the performance, unfortunately, has been not that great because of the pandemic. And it's actually not Air Canada alone. In fact, all airlines around the world, they have been badly hit by the coronavirus pandemic. The one word that we use for financial condition and performance is actually financial health. So as a finance manager, one of your job is actually to evaluate the financial health of a company. And as I said here, finance managers are just like physicians and doctors. So what doctors do, they need some tools for assessment. So in order to assess the health of their patients, of course, they need some tools, like for example, thermometers, blood pressure machines. And of course, they also need, let's say, laboratory tests. And after all those tests, they can form an educated opinion and informed opinion, and then they can prescribe accordingly. Finance managers, as I said, they're just like physicians. They also need some tools in order to assess the financial health of a company. And one of the tools is actually financial ratios. So financial ratios, as the name suggests, is just like any other ratio. It's an index. And how do we get this index? By two accounting numbers, by dividing one number by another, just like this one. So it has a numerator and it has a denominator. But financial ratio, as you can see from the definition, it actually relates to accounting numbers. Now the next question is, where are these accounting numbers coming from? Of course, they are coming from financial statements. And that's why these analyses are called financial statement analysis. Now, depending on the numerator and denominator, we can divide the ratios into two different types. One is balance sheet ratios. So whenever, let's say, both the numerator and denominator, if they are coming from balance sheet, those ratios are called balance sheet ratios. For example, and I copied this figure actually from the book. So if you see liquidity ratios, they are purely coming from balance sheet, all those accounting numbers. So that's why they are balance sheet ratios. But some of the ratios, either the numerator or denominator, they're either coming from balance sheet or income statement or from both. So those are called income statement or balance sheet ratios. So there are two types. You can also actually categorize it in three different types. For example, balance sheet ratios, income statement ratios, and then mixed ratios. But the book uses only two categorization. One is balance sheet ratios, and the other one is income statement and balance sheet ratios. So it's simple. If both the numerator and denominator are coming from balance sheet, I repeat, they are balance sheet ratios. And if they are coming from multiple sources, for example, balance sheet and income statement, then they are called income statement balance sheet ratios. The next question that we should ask ourselves is, why ratios? Absolute statements and numbers are misleading. And why are they misleading? I'll give you an example. So suppose if I ask you a question, suppose you bought a laptop recently, and I asked you a question, how did you like it? And you tell me, oh, I didn't like it because it's a little bit heavy. Now the question is, heavy compared to what? Is it heavy compared to, let's say, any other laptop in the competition? Or is it heavy compared to, let's say, your sister's laptop? Or let's say, is it heavy compared to a desktop? Now, comparison of a laptop to a desktop, it will not be a good comparison because these are like two different animals. You have to compare similar stuff. So if you give a statement in absolute terms and do not relate it to anything else, it's misleading. It doesn't give you enough information. Let me give you an example from finance. So suppose a company makes $1 million profit in a year. So if you see this information in absolute terms, this performance is fantastic. $1 million is a lot of money. But what if the company has invested, let's say, $200 million in total assets? So if I now relate the profit of $1 million with $200 million investment, the return on investment, it is also called return on asset, but a more used term for this ratio is actually return on investment. So return on investment in this situation is only 0.5%. So $1 million in absolute terms, it looked fantastic. But let's say if I calculate a ratio of return on investment, the performance is absolutely pathetic. It's only 0.5%. Now suppose if your company is operating in an economy where the government bond, which is a risk-free security, pays 4% annual return. So will you be happy with 0.5% return? Probably not, because you are only getting 0.5% return and you are taking some risk as well. On the other hand, you had another opportunity where you could make 4% return without taking any risk. So the whole point is the calculation of ratios is extremely important. And as I said, if you look at different things, even the financial numbers in absolute terms, they are misleading. There are certain uses for financial ratios. One of the most important use is internal comparisons. Example, how does return on investment for your company look like over the years? Just like this one. So let's say if for 2019, your return on investment was 5.3%. As a finance manager, sometimes you're curious, and you're curious for the right reasons, that how is this performance compared to our last year's return on investment? So of course, you can use financial ratios for internal comparisons. And if you're comparing those ratios over a period of time, it's called trend analysis. Financial ratios can also be used for external comparisons. And whenever we are talking about external comparisons, normally you compare the financial ratios with industry. So for example, internal comparisons suggest that the company's return on investment is increasing year by year, which is great. It means that your company is moving in the right direction. You're making more money compared to last year. But the external comparisons on the other side suggest a different story. So it's not only your company who is making more money, it's actually an industry-wide trend. So for example, In 2017, the return on investment in your company was 4.1%, but the industry was 4.5%. 2018, your company made 4.7% return on investment, and the industry, it was 4.9%. And for 2019, 5.3 versus 5.7. So if you see here, there is 0.4 percentage points difference between the industry and your own company. So if you compare your return on investment with the industry, it's below average. So that is something that you could actually improve upon. So the message from this slide is that you can use financial ratios for internal comparisons through trend analysis, and you can also use those financial ratios for external comparisons. And external comparisons, you simply compare your ratios with industry. Now, this is something important. You can use any ratio for your analysis. So in this chapter, actually, we will cover only the most important ratios which are used in the industry. But as a finance manager, you can calculate whatever ratio you like. But the ratio should make sense. For example, return on investment makes perfect sense. Not all ratios, unfortunately, make sense. For example, there is hardly any intuitive or logical interpretation, let's say, for this ratio, cash divided by owner's equity. So let me give you an example from the industry. I have downloaded an annual report from Engro Fertilizers. And if you see the profitability ratios, there are plenty of them, more than actually 24, starting with return on equity. Return on equity, one is after tax, the other one is before tax. Then return on capital employed, pre-tax margin, and then there is another pre-tax margin where you include the subsidy. So the whole point is that you can calculate whatever ratio that you like, but the ratio has to make some sense.